And you're going to go over chapter 5. We covered chapter 4 last time. So let's close this and go to chapter 5, which is about receivables and sales. So we are going to see how to recognize accounts receivable. What does it mean, credit sales? That means sell on credit. That means recognition of accounts receivable. What is net revenue? Net revenue is it's revenue minus sales discount minus sales return and allowances, and that gives you net sales or net revenue. And we also like to know how to estimate uncollectible accounts or bad debt expense, right? You normally need to estimate that and recognize a proper amount of bad debt expense on December 31st each year at the end of the calendar year for your company. The reason is the bad debt expense, you cannot wait till it happens. It will be in the next year, and that's too late. According to GAAP, anything that happens in this year needs to be recognized in this year. So if you have a lot of accounts receivable and sales for this year, then before the year ends on December 31st, you need to estimate a proper amount of uncollectible accounts and recognize bad debt expense for that. And for bad debt expense recognition, according to GAAP, GAAP says we let you use allowance method, not direct write-off. Direct write-off method is when you need to recognize bad debt expense when it happens, but GAAP says that's too late. If it happens in summer of next year, then that's too late. So bad debt expense using allowance method needs to be recognized, the bad debt expense, on December 31st. And that's what GAAP is accepting. Direct write-off, it's maybe good for a, let's say, small business cash basis accounting, those type of things. But according to GAAP, you need to use allowance method. And there are also some parts of note receivable, how to recognize note receivable, and also some analysis in regards to receivables. Okay, so I like to solve some problems, which also is helping you to do your homework for chapter 5. So exercise chapter 5. You have a bunch of exercises as a homework problems. I will do some of them, and hopefully that will help. Okay, so let's say number 5. On May 7th, company provides services on account to Michael's Wolf for $4,000. Michael pays for those services on May 13th. For corporation, record the service on account May 7th, and the collection on May 13th. So that's an easy journal entry, and I can show you the answers anyway. So here we go. So when you sell something, obviously you always recognize accounts receivable as an asset. That's a debit. And then you recognize the revenue as a credit. If it's paid cash, that's great. But normally, most of the times, it will become as sending an invoice and wait for a check to be arrived down the road. So that's accounts receivable. That means sales on account. Maybe a week or 2 or 3 weeks later, let's say you get a check, and that's the moment you recognize the cash that you received, and you debit it in your cash dash checking account, let's say, or cash dash saving account, wherever you want to deposit that. And then accounts receivable will be closed. So it's a very straightforward recognition of sales and then recognition of collection. In problem number 2, it says Mary Maidens generally charges $300 for detailed cleaning of a normal size home. However, to generate additional business, Mary is offering a new customer discount of 10%. That's a trade discount. Though trade discount, it's an immediate discount on the spot. On May 1st, Miss Person has Mary Maidens clean her house and pays cash equal to the discount price. So, as I said, trade discount is an immediate discount, right? So all you're gonna record is just the actual sales. The actual sales is, let's say, debit cash or debit accounts receivable. In this case, it's cash. So debit cash, $270, and service revenue for $270. So trade discount is an immediate discount right away on the spot. And in order to recognize this and record this, you always record the after the trade discount, whatever it might be. Here is 270. Okay, that was also fine. Let's go to number 3. Again, that should be a homework problem, I believe. So number 3 says, on March 12th, the company provides services on account to a hospital for $11,000. So you have to recognize that. The terms of this sale is $210 net 30. That means 2% discount if it's paid within 10 days. Otherwise, the net amount is due in 30 days. Grace pays for those services on March 20. March 20 is less than 10 days, so they should be able to take advantage of this 210 net 30. Before we continue, I would like to show you something that it's important to know. It might be in an exam in my class or in a CPA exam or something like that. So I like to show you this before we go. So 2%, here is my percentage. So 2% discount. And then the other information I have goes in other spot, right across that information, which is 2% discount if it's paid. Let me write this down here. It's 210 net 30. What does it mean? That means if you pay in 10 days, you get 2% discount. However, if you like to keep your money in your pocket and don't pay for another 20 days, that's fine because it's due in 30 days anyway. But because of that extra 20 days that you can keep money in your pocket, you're gonna lose that 2% discount. If you want that 2% discount, you need to pay in 10 days. And this is a payment method. And there are different methods like this, like 110 net 30, 110 net 60, 115 net 60, whatever it is. So the idea is to understand what that means. And here is the situation now. So 2% discount if you pay late and keep money in your pocket for 20 days. So because of 20 days keeping money in your pocket longer time, you lose that 2% discount, right? So you have to pay that extra 2%. But we don't understand exactly what this means in real life unless you make it to an annual basis so everyone can understand. Because when you want to borrow something, you always ask, what is my annual interest rate, right? So same thing here. You want to know what is this annual interest rate. And in order to do that, so you have 365 days, for example, in one year. And this is your annual interest rate that is missing. So I'm using an algebra, and just learn how I use this algebra because it will make your life so much easier in your business, in your exams, to calculate things that you want to know on the spot. So here we go. I have these two available. Simple algebra, multiply, right? Those two are available, cross each other, multiply. The answer, divide. So 365 times 2 divided by 20. And that will be 36.5% annual interest rate. That's crazy amount of interest rate they are charging you. So if you are a manager, you definitely want to pay every single possible payment that has such a possibility of saving. You want to pay it on the spot in below 10 days. Even if necessary, go borrow from somewhere else, because no matter what you do, how much you borrow, with what interest rate, it will not be 36.5% annual interest rate. So it's better to pay all these type of invoices within that 10 days time period to get the discount. So what is the annual interest rate for this? It's not 2%. It is 36.5% annual interest rate. So it's a very big deal. It's not something that you say, 2% is not a big deal. It is a very big deal. Okay. Let's remove this. Turn on my camera. Go back to sharing. And here we go. Okay, so the solution I have for you is here. The solution is you recognize the accounts receivable for $11,000 and credit service revenue for $11,000, right? By the time you receive this check within 10 days, actually you get what? You get a check for much smaller amount, just $10,780. You're gonna close the accounts receivable anyway, right? And the difference of the check that you received and the 11,000 accounts receivable that you are closing is that sales discount that you are recognizing right now as a form of $220. So if this is all you have for your business, if I ask you what is the net sales that's going to be in the income statement, you're going to say net sales in the income statement will be 11,000 revenue minus or less sales discount of 220 equals net sales of 10,780. So net sales here is 10,780. So what is net sales? Net sales equals to sales minus sales discount minus sales return and allowances. Sales return and allowances, it means you sold something, but some of those sales, the customer returned it. And therefore, you recognize sales returns and allowances. So sales returns, that means they physically return the product to you. But what is sales allowance? Sales allowance means they don't want you to return it, but they give you credit for it. Sometimes you get credit very large amount, sometimes you get a credit small amount. I give you an example. I bought something from Amazon. It was about $20 or maybe a little bit less. And then after 2 weeks, I tried to return it. And for some reason, the app was not working. So I called the customer service and I said, I don't want this. I want to return it. The app is not working. And they said, you know what? We're going to give you allowance on that. So they credited my account for $20, let's say, whatever it was. And they said, you don't need to return it. Just keep it or throw it away, whatever you want. We just give you credit. So that is allowance. Allowance means there is no physical return, but the company is providing allowances to the client. So they get that money back in their account, but they don't need to physically return the product. But when you say sales return Sales return means actual return of the product. Okay. Okay, that's number 3. Let's do number 5. Number 5. Okay, so this is number 5. Actually, let's do number 4. It's interesting. It says, refer to information to 5.3, but now assume that Grace does not pay for service until March 31st. So what do? The same problem, but you see here, we said if you pay below 10 days, you get a discount, right? Here, right? So if the customer pays after 10 days pay period, so in this case, the customer has to pay the whole thing. That's what you get. The company gets $11,000 check and accounts receivable is closed. And the reason is because this was paid after the discount period. Cool. In order to be in discount period, it should be paid 10 days from March 12th. If not, then no discount day. Okay, so in March, exercise 5. Here is the book right there. So exercise 5 says, refer to information on 5.4. For Grace Hospital, record the purchase of service on account on March 12th and the payment of cash on March 31st. So purchase of service on March 12th and then payment on March 31st. Got it? The same problem, but from the buyer's point of view, customer point of view. So the customer will recognize the same problem that here we did. We did this, right? See, this is the seller, right? Okay. Now, the same thing, the buyer, the customer will do this. The customer says service fee expense of $11,000. That's debit. And accounts payable should be recognized as $11,000. Okay. And then because it's paid after March 31st, they're going to recognize accounts payable of $11,000 debit and cash credit for $11,000. Okay. So you see both sides of the transaction. Let's do number 6. On April 25th, the company installs wiring in a new home for $3,500 on account. However, on April 27th, foreman's electrical work does not pass inspection, and foreman grants the customer an allowance of $600. You see, allowance means there's nothing to return, just they get an allowance because of the problem. The customer makes full payment of the balance owed, excluding the allowance, on April 30th. So record those transactions. So here we go. So the company sold services. So accounts receivable is debit. Service revenue is credit. That's what the invoice says, right? But a few days later, the inspection didn't pass and the customer was not happy. So the company provides sales allowance. Remember I said there's sales returns and allowances. Returns, that means a physical return. Allowance, that means there is no physical return. It's just an allowance. That's a debit. That's a contra account to sales. And accounts receivable will be reduced because of that by $600. That's a credit. So right in this situation, what is the net sales? Net sales is sales, $3,500, less sales allowance of 600, which is a contra account to sales. And net sales will be 2,900, 35 minus 6. Requirement 3, the company is receiving a check for $2,900, right? And accounts receivable for $2,900 will be closed at that point. And you might say the accounts receivable was 35, yes, but here you remember because of the allowance, accounts receivable went down. Therefore, it's now just $2,900 to close. And the net sales, how much is it? Is sales $3,500 less sales discount, which we don't have it, less sales returns, which again, we don't have it in this scenario, less sales allowance, $600, and that gives you net sales. So what is net sales? Net sales is sales minus sales discount, minus sales returns, minus sales allowances. During 2021, it's first year of operation. Why is this so important problem? You have to understand what this means. This means because this is a brand new company, there is no balance in allowance for doubtful account, T account, coming from previous year. Allowance for doubtful account has no balance, zero balance, because it's a brand new company. Keep that in mind. So draw a T account, call it allowance for doubtful account, and the balance is zero on the credit side. Balance is zero. Okay, continue. Pave Construction provides services on account of $160,000. So put that in the T account. So I'm right now drawing a T account. Accounts receivable debit, $160,000 on your paper, please. Accounts receivable debit, and sales credit, $160,000. So that's done. By end of the 2021, cash collection on these accounts totaled $110,000. So here we go. On your T account, cash debit, $110,000, and accounts receivable credit, $110,000. That way, your accounts receivable has a balance of $50,000 at this moment. Okay, so just stop sharing for a second, show you my paper. Just make sure you have the same thing on your side. Here's my paper. So accounts receivable is 160, sales is 160, you collect 110, accounts receivable goes down by 110. That means you have $50,000 balance on your accounts receivable by end of the year. And by the way, because this is a new company, so allowance for doubtful account has a zero balance. Why zero balance? Because as I said at the beginning, it says it's a brand new company. So there is nothing in allowance for doubtful account. And that's a very piece of information, very important piece of information. Okay, remove pin, go back. PAVE estimates that 25% of uncollectible accounts will be uncollectible. That means accounts receivable, whatever it is, 25% as a form of estimate will be uncollectible. In 2022, the company writes off uncollectible accounts of $10,000. So next year, that's what it happens. So let's look at the solution now. Here we go. So 25% of $50,000, that's $12,500. And that's what you estimate that it might not be collectible. You don't know for sure, but you estimate it. The reason is because whatever happens in 2021 as a form of revenue or expense needs to be recognized in 2021. So here, as you see, by end of December 31st, 2021, before next year starts, I need to recognize a proper amount of bad debt expense. And I'm estimating $12,500 should be a good estimate. And I put $12,000 in allowance. So put it in your T account in your book. Here is a bad debt expense, debit $12,500, and put $12,500 in the allowance for uncollectible account or doubtful account. Either way is fine. Allowance for uncollectible account or allowance for doubtful account is the same thing. Next, in summer of 2022, all of a sudden, one of the customers will be uncollectible and totally for sure, and we're gonna write it off. So in order to write this off, you debit the allowance for $10,000, debit allowance for $10,000, and credit accounts receivable for $10,000. At that situation, your allowance has $12,500 credit side balance, and your accounts receivable will be written off by $10,000. That means you should have about $40,000, let's say, accounts receivable. So what is the allowance for uncollectible account showing right now? The beginning, we started with $12,500 on the credit side, but then we wrote off on the debit side $10,000. That means ending balance in 2022, your allowance for doubtful account shows $2,500 credit side balance. Okay. Now, this $2,500 is very important information, again, for year 22, December 31st. Because in year 22, December 31st, assuming same thing happens again, right? And you wanna estimate 25% of 50,000, 12,500. So the next year, you have already 2,500 in it, right? You have already 2,500 in the credit side. So all you need to do, if you need 12,500, let's say for the year 22, all you need to do here to debit 10,000, right? Why? In year 22, you debit 10,000 because you have already 2,500 in the credit side sitting and doing nothing. So you have to consider that and just add another 10,000 to the allowance to make it to 12,500 again. I don't know if this is in your book or not, but kind of not sure. I don't think so. But anyway, I'm gonna tell you, and you might need to learn if you want to take a CPA exam or something. If you use percentage of credit sales, percentage of accounts receivable, right? To calculate, like here, like this example, the balance in the allowance, remaining balance in the allowance on December 31st, whatever it might be, it's very important, right? Because you calculate based on that. As I said, because here you have 2,500 for year 22, if you want another 12,500 to be in your T account, you just debit 10,000 to make it 12,500. But if you use percentage of sales, percentage of net credit sales, percentage of net credit sales is different than percentage of accounts receivable. Percentage of net credit sales, it's a very much large amount. For example, here your accounts receivable was how much? Just $50,000, right? But your percentage of net credit sales, your net credit sales is not 50,000. Your net credit sales is probably, maybe 5 million, right? So net credit sales percentage, you are calculating based on the big amount of net credit sales for the whole year, which let's say, for example, 5 million. Then in that scenario, the dollar amount that is in the allowance for doubtful account, the leftover dollar amount, let's say in this example, this 2,500, it's not important. And you just calculate 5 million, let's say, credit sales times 25%. Not in that case, not going to be 25%. If you go with credit sales, you might say just, for example, maybe 3%. So 3% of your net credit sales, whatever it is, you just debit or credit that, like this example. So in regards to percentage of credit sales, the balance remaining in the allowance for doubtful account, it doesn't matter. You don't use that amount to calculate how much to debit credit. But here, because we use percentage of accounts receivable, then using percentage of accounts receivable, that means every $1 that is remaining in the allowance for doubtful account needs to be considered for your calculation to know how much you need to recognize for bad debt expense. Here, why we calculated 50,000 and we exactly said 50,000 times 25%, that's 12,500, and we just did 12,500. Why did we use 12,500 exactly? Because the balance in the allowance doubtful account is 0. So 12,500 minus 0 is 12,500. That's why we did 12,500 in here. That's the reason. Because after deducting from this 12,500, the $0 balance on the credit side, we still need to do 12,500, no matter what. Okay, let's see what is the requirement number 3. Assume that same fact as above, but assume actual write-off was in 2022 was $15,000. Record the write-off account receivable in 2022 and calculate the balance of allowance for uncollectible account at the end of 2022. So that means you estimate something, but your write-off was way more than that. So you estimate that you need, let's say 12,500, just like here, right? You estimate that you have bad debt expenses of 12,500 plus $0 existing, it's still 12,500. But here you are writing off way more than that, $15,000 write-off. That means in this situation, your beginning was 12,500, but you wrote off 15,000. That means now you are on the debit side, on the deficit side of allowance for doubtful account. Now you are on the deficit side, on the debit side of allowance for doubtful account. Cool. Okay, so let's do number 10 because it's in your homework, I believe.
Professor, going back really quick on the same one that we just did, sorry to interrupt you, on where you wrote the write-offs for the 15,000 debt. So the ending balance isn't a negative amount. It's still 2,500.
Yeah, it's negative amount. That means it's on the debit side. That's what we say.
Oh, okay.
So let me show you the stop sharing for a second here and with my camera so you can see what I mean. So here is a pin. So I put this on the T account as we were speaking, right? And you see the bad debt expense is 12,500 and the allowance is 12,500. We wrote off 10,000. That's why we have 2,500 on the credit side still left. We didn't use it for any write-off, right? But if you write off instead of 10,000, if you write off 15,000, like 10,000 for one customer and 5,000 for another customer, like that. So all of a sudden, 10,000 plus 5,000 is 15,000 minus 12,500. So your balance will be on the debit side. And as soon as allowance for doubtful account has a debit side balance, we say that's a deficit. That's a negative balance. That's a deficit on the debit side.
Okay, so then, so if it's a deficit, then you would put like parentheses around it?
No.
Known as a deficit, or just put debit?
No, in a T account, debit or credit, it's just a number.
Okay.
But what that means is important. So in this case, it means when I see a company has a debit side allowance for doubtful account, automatically, without even looking at that area, by just seeing it, this 2,500 right there, I know in here, we estimate less and we wrote off more. That's why I am on the debit side. Okay. That means if I am the auditor, I'm going to tell to this company, how much did you estimate last year? And they say 25% of accounts receivable. And then I will say, apparently that was not enough because right now you are on the debit side. So this year, how much you are going to estimate? And then company says, okay, because of our estimation was not good and we believe it might happen again. So we're going to estimate instead of 25%, we're going to estimate 30%. And I said, okay, let's try 30%. And as an auditor, I let them go with the 30% estimation. Now, let's say this is the situation in year 22. And I say, okay, how much accounts receivable do you have this year? They say 35,000. I say, okay, you have 35,000 accounts receivable. That's good. So we go with 35%. So 35,000 times 35%. That gives me 35,000 times 35%. That gives me 12,250, right? 12,250. That's what we need to have there in here. How much? 12,250. But I am already 2,500 in deficit. So how much do I have to do the journal entry to make it to 12,250? So because I'm already 2,500 deficit, so I'm going to add another 2,500, and that will be 12,250 plus 2,500 deficit. So that's 14,750. So I'm going to put 14,750. That's a credit. 14,750. That's a debit for bad debt expense. Okay. And 14,750 less 2,500. That's 12,250. And that 12,250 exactly matches with this 12,250 that I want. I just got that number right there. Got it? So this balance,
yes, understood.
That balance is so important. And why this balance is so important? One more time. Probably this is not in your book. I'm just telling you. This balance is so important because I use percentage of accounts receivable percentage of accounts receivable. If I use percentage of accounts receivable, then this balance, it's gonna be very important for my calculation of how much to do debit credit in order to get to that point that I want. However, there is another allowance method also available, acceptable by GAAP, which says instead of using accounts receivable balance and get a percentage of it, you can use percentage of sales. Percentage of sales. If you use percentage of sales, remember, if you use percentage of sales, then whatever you calculate, then that 2,500 is not important anymore. So if I use percentage of credit sales, so $160,000 times, let's say 5% will not be collected. This is sales, right? Credit sales, percentage of credit sales. So 5% of that, $160,000 times 5%, that's $8,000. As soon as I get that number is my journal entry. I do not care how much is inside this allowance anymore. So if I show you the same scenario, here is the allowance and has $2,500 on the deficit side. Because it's $8,000 here, I'm gonna do 8,000 allowance debit and 8,000 bad debt expense. Bad debt expense debit, allowance credit. And yes, my situation will end up to be, let's say 5,500, but I don't care. Because I use percentage of credit sales, and credit sales, it's a very large, big number compared to my accounts receivable. That's why the existing balance in allowance will not be important anymore to consider. And that's how the answer will end up. So if you are taking a CPA exam, for example, and it says percentage of credit sales, then remember the balance in allowance is not important. If the problem says use percentage of accounts receivable, then immediately you need to know, oh, wait a moment, the balance in the allowance is gonna be all of a sudden very important in my calculation. So percentage of accounts receivable or percentage of credit sales, both of them are allowance method and it's acceptable by GAAP. Set number 10 because it might be in your homework. Yeah. So here is number 10. In number 10, it says, the company has the following balances on December 31st, 2021. Before any adjustment, accounts receivable equals $70,000. Allowance for uncollectible account or doubtful account equals $1,400 on the credit side. Very, very important information. Mercy estimates uncollectible account based on aging of accounts receivable as shown below. Aging is just like percentage of accounts receivable, but it's a little bit more precise, but needs a little bit more work. So instead of just saying how much is your accounts receivable and get a percentage of that, we are going to be more specific and get an estimate of every category of accounts receivable that we have. 30 days late, 90 days late, over 90 days late, and then estimate a little bit different, higher and higher for each category of late accounts receivable. So it takes a little bit longer time, but after you do that, then you multiply, right? And to see how much you need to estimate. So here is the answer. So 50,000 times estimated 15%, that's 7,500. 30 days late, 11,000 times 20%, 90 days late, 8,000 times 45%. Over 90 days late, then it's high probability, so $1,000 times 85%. Add them up, so we need 14,150 exactly. How much? 14,150 exactly. Why exactly? Because we use we used percentage of accounts receivable method. Okay, so we have already 1,400 in the credit side. We're gonna take advantage of that. And all we need to record is only bad debt expense for 12,750. Because when allowance, now we credit 12,750 plus 1,400 already existing in the balance, it will become exactly 14,150. So what is the net accounts receivable at that point after recognition of this? The net receivable will become 70 minus allowance for doubtful account, and it gives you net receivable of 55,850, and that 55,850 goes into balance sheet. So how much accounts receivable do I have net in the balance sheet? 55,850. So allowance for doubtful account is a contra account to accounts receivable. Cool? You might say, how about if that 1,400 was on the debit side? If 1,400 was on the debit side, then we say 14,150 plus 1,400, and that would be our journal entry. But because this 1,400 is on the credit side, so I have already 1,400, all I need to do is just add another 12,750 to the allowance to make it to 14,150. Okay, so I solved a few problems on chapter 5. You have a few more problems. Hopefully you do it yourself at that point, and that will be a good practice for you. If there is no question, I will see you next week.
Okay, thank you, Professor. Have a good